Hey, happy Valentine's Day.
We are one day late, but is that for me? No, it's got an M on it.
Yeah, it's for you. I'll slip it right under. Oh, how cool would that be if I would have done it right here and then you would have popped up?
Well, in the prisons, they attach it to a cockroach. They let the cockroach run through the doors.
I wouldn't know anything about that, Brett.
No, I saw Orange is the New Black. That's how they got.
You know what? Let's go back to the prison real quick. Let's bring this to personal finance and what's going on in markets. Why can Bitcoin be a currency? Because cigarettes can be a currency. Same idea. I don't care if they don't have a taxing body. People just have to agree. People have to be willing to accept it in exchange for a good or service, like protection from bad things happening to you within the walls of a prison, and that counts as a currency. So Bitcoin, look, I'm bullish again. There you go. I was bearish when we started. Now I'm bullish.
We traded cows hundreds of years ago. Do you think a cow should be worth $50,000?
Oh, Brett, Neil Ferguson, you know him? Because you should. He wrote a book, The Ascent of Money. There were puka shells. Before you wore them on your neck, you exchange them for goods and services.
That's fine. I have no problem with you can exchange anything. You can barter, right? Trade. That makes sense. It's the value that it costs to buy one Bitcoin or one stupid other cryptocurrency like Dogecoin.
Wow. I think we need to have our first guest on this little show we have be a crypto maximalist, just so we see what happens.
How about a crypto minimalist add next to me?
I was about to say, we already have one of those. It's you. It's you, Brett.
Look, put on the gloves. Let's box it up this.
All right. Welcome to Talk Your Chart, episode more than 10. I forgot what number we're on. Okay, start over because I don't remember what episode we're on.
That was good.
Yeah, hold on. What?
Do you want to know?
I don't remember what it was.
You want to know what it was?
Welcome to Talk Your Chart with Brett and Marcos. I still don't remember what episode number we're on, but it's more than 10. I will be kicking us off today, Brett, if you don't mind. And it's going to be something it's caught a couple of headlines. I'm not sure if it's going to come across your new feeds, inflation. We just got a 7.5% reading on the consumer price index over the last year. Needless to say, people are talking about it. I guess, well, I was going to say me, but neither of us have ever lived in a time with excessive amounts of inflation. I think it's been quite the opposite. Inflation really hasn't been a meaningful economic headline for a very long time. And ultimately, the meaningful inflationary economic headline was the opposite. How low it has been for so long. Is it ever going to be something that's meaningful? Has there just been a structural change? Yada, yada, yada. Basically, I think what this last two years has shown is the fiscal experiment of actual money printing, not just the monetary policy of budget deficits and funding through debt monetization, right? Basically, the Treasury issuing bonds and the Fed buying those bonds, right? And all that money printing in that sense is very different from the fiscal sense of, Brett, here's $100, go do this as you so please. What have we seen after that experiment? A ton of consumer spending in the form of buying stuff.
Well, this is even very different than the inflation that happened in the 80s, early 80s, late 70s with oil, right? So we had a high inflation before. I was only a few years old, but yeah, the reasons for it are very different than what happened previously.
Yeah, precisely. That's without a doubt the talking point. It's different now. And also a lot of people who are talking about it haven't even lived through a time like this. So the chart that I brought up here is what's called the 10-year TIPS Treasury break-even rate. What the heck is that? I guess a real quick step back. Let's look at TIPS and what those are. TIPS stand for Treasury Inflation Protection Securities. Those were born in 1997. Basically, the U.S. Treasury saw an appetite in the market for a certain type of Treasury bond that would protect an investor against surprise levels of inflation. So not necessarily going to be the wonderful investment for just dealing with normal inflation, but when you get unexpectedly high inflation, these things basically pay out a premium that benefits when you get that surprise inflation, i.e. it helps you beat it. So a lot of the times, and I know you and I have done this together, when a client asks us, what's the best thing to own? We'll say, yeah, TIPS makes sense, but ultimately over long periods of time, stocks are second to none. So that's the function of a TIPS.
Tips, just be clear, tips usually will pay a lower coupon, a lower interest rate because they have that
Yes.
inflation component that will then increase the price, right?
Yeah,
So
precisely. They're 100%. The purpose is solving for unexpected inflation. And then the other side of it, the treasury break even, is just what's the yield on the 10-year US treasury. You get the difference between those two yields, right, or the spread. And that basically is what the market is anticipating inflation to be, in this case, 10 years in the future. They have different 5-year, 7-year ones. The one that's most often quoted and that you'll hear about is this 10-year figure. What's interesting to see is the reaction in this chart that we're looking at. If you go back to, let's look at it, early 2020, you'll see falling off a cliff where the 10-year break even dropped to 50 basis points. Why is that? Because the economy shut down. So what was the market expectation? You're not going to be able to do anything. You're not going to be able to produce anything. So what's the expected increase in prices? Not very much to nothing. And look at the immediate, it's almost been like what, a 90, 100% increase since then. From March 2020 to now, we're looking at 2.43%. So what's this telling us? The market, which is voting using billions of dollars, right? Because these are actual market participants buying these contracts, is telling us that the expected 10-year inflation rate is 2.43%. But wait a second, wasn't inflation just 7.5% over the last year? Yes, it was, and that's not a fake number. What I think this break even helps an investor do is don't be myopic, right? That fancy word of don't be short-sighted. Let's think about an entire market cycle over time. And let me bring it in, not even just 10 years. Let's look backward. Brett, let's do, if we looked at a 3-year inflation rate. So that includes end of 2019, 2020, 21, and now beginning of 22, right? So call it 3 years. Going back then, the average annualized inflation rate since then, including this last print of 7.5%, 3.5% annualized.
Well, I think it's reasonable for someone to say, look, I'm super concerned about inflation and I'll take the over because really, as you said before, this is one of the best ways to protect yourself against inflation. So if you really do believe inflation will be, coming down from 7, will still be 6 and 5 and 4 and 3 and be higher for the next decade, it probably doesn't hurt to buy them just to protect yourself. Because in the event that you're wrong, let's say inflation is only 2, you're not that far behind. Right? It's not like inflation has to average 5 for you to actually beat treasuries.
Yeah, I hear you. The tips are also crazy expensive right now, right? Because of the run-up that they've seen. So I'd hear you, but I'd also, again, you love how actually, no, you don't love how I always drop all the lines, but you can't buy yesterday's performance. So if you're looking forward, I think, in my personal opinion, the Fed dropped the whole transitory line too soon. And I think if you look at most economists and what you're reading, a lot of them are thinking we've probably topped out on what you've seen from an inflationary standpoint. And here's, I guess, here's a big guess. And it'd be interesting, who knows, but I wouldn't be surprised, especially given where the Fed finds itself, unless Powell gets confirmed tomorrow and then he suddenly can become more dovish because his job's secure. I would be afraid of hearing about recessionary and deflationary becoming the new headlines in markets over the next 6 to 12 months, just because these things turn over, right?
Yeah, it's possible, but I also think the clients that we talk to are basing their expectations on, or their fears on, what they've experienced in their past, right? Whether somebody grew up and that was a major pivotal point in their lives in the late 70s, early 80s, whether they grew up in a Central American country or South American country where they had high inflation, like those things, you've got fear for that. It really doesn't matter whether you're right or not, whether we do hit a recession and rates drop or they continue to be high. So I think you can't discount it for someone saying, I'm fearful of this because of my past, right? Just like depression babies, they're still fearful of that.
I totally get that. Last data point that I want to say, in October of 21, the makeup of the consumer price index was about 60% in used vehicles, reopening categories, energy, and new vehicle and parts. In the last print, that's down to 20%. Why do I say that? Because that means that a lot of the increase is coming from housing, groceries, and all other categories. Perhaps non-reopening categories. Does that make you a little bit more worried that it's broad-based inflation? Maybe. I have no idea. but just interesting to look at the data and how it breaks down.
Okay, well, we'll see how this plays out. There's a lot of interesting facts that are going to come out of the next 12 months about where inflation goes, how quickly this goes back down to where it was, and supply chain issues, the wage inflation, all those things.
Yeah, wage inflation real, and not necessarily it's good, but if you're not beating inflation, then it's tough. But I'd say wages are going to be stickier than price inflation is. Let me last thing, prediction. I think going into summer, we get downward pressure on the CPI numbers. So I think this one might have been our highest print that we've seen. And I think we can start getting to the 3 to 4s or maybe 4 to 5s. All right, let's go 3 to 5 into summer. You agree or disagree?
I'll wait till the fall before I see under 5, but I tend to agree with your premise that we'll see lowering rates going forward.
Okay, so time on. So let's do this because we'll call each other out. I think 3 to 5 beginning of summer. You think 3 to 5 out of summer. Okay.
Under 5, yeah, by Labor Day.
Okay. All right.
So I want to switch gears a little bit and talk about something that made major headlines at the end of December. And that was some information that Vanguard put out on their mutual funds. So Vanguard, is one of the behemoths in the industry, and they have something called a target date fund, which a lot of people are familiar with. These are funds that basically get less risky as somebody gets older, right? So they start off very aggressive, and as you get closer to this target date, whether it's a year, usually it's a year that they have, 2035, 2040, whatever it is, they get more conservative. And a lot of people put all their money there because it's something that automatically sort of rebalances, right? Automatically does its thing. It changes over time. You don't have to worry about it. I don't know about you. I don't necessarily like it for a lot of clients because I don't think that most of our clients should be in a situation where they got to get less risky over time. What's your feeling on that?
I think it just kind of depends, because what I'll tell you is, compared to cash, target date funds are better.
Sure.
And don't let perfect be the enemy of good. And I think that definitely applies to target date funds. It's not a perfect solution. It's not an optimal solution, but it's better than a lot of other things. So that's number one. Number two is, they used to be riddled with high fees because they were funds of funds. Vanguard does a good job of giving you an inexpensive target date fund. I just don't love that they're associated with this idea of set it and forget it, and that's okay. Because what have you found a lot of times? Investing doesn't stop when you've retired or when your target date hits. Right. That's a little bit arbitrary. So if you're not paying attention, I think it can lead to a bad outcome.
Yeah, it's a one size fits all approach. So if someone doesn't have a financial planner, if somebody is trying to figure it out on their own, it's not the worst thing in the world. But what we saw is a lot of people invested all their money in these funds. A lot of them did it in non-retirement accounts. And what happened is, we see in this chart here, is that these funds paid out super huge capital gain distributions at the end of December. Some of these funds paid out 22, 20, 30% in capital gain distribution. So this is the fund over the course of the year making changes within it, whether it's fund investors who are selling and then they have to sell stocks within, whether they're changing the consistency of the fund within, so all those changes, all those sales within the fund then spit out to the investors. So
this was the Boggleheads group on Reddit. They went absolutely bananas when this happened. And they were basically saying, Jack, why'd you do this to me? So the reason this happened is because, I don't know if you're going to go into that, but basically they have a certain share class the target date fund is the same fund with different share classes. At a $5 million minimum, you get a certain share class. At a $60 million minimum, you get another share class. They changed it so that a different group of investors had a smaller minimum and could go into a lower cost fund. So they basically sold from one set of the target date funds to buy into the cheaper ones. And when that happened, when they sold across that one series of target date funds, that's what this created. Because as you know, mutual funds, when I sell my mutual fund, Brett has to pay the tax too.
Yeah, this is solely a taxable event. There is actually no positive associated with a capital gain distribution. Usually they occur at the end of the year. And normally they tell you in advance this is coming. But if you've been an investor in this fund for 30 years and you've got a 50, 100%, whatever the number, unrealized gain in that fund, you're not going to sell to avoid a 20% capital gain distribution. But if you own $2 million of this fund or $1 million of the fund, or even $500,000 of the fund, it's an enormous tax event. So some people were taking the tax gain, then having to sell funds to then pay the tax to be able to come up with the cash to pay this. So it's a huge inefficiency in owning this fund in a non-retirement account.
Yeah, and I think the worst part of this, because the taxes are taxes, sucks to pay them, but the bill comes due eventually. I think the big issue here was expectations and how much of a surprise this was to everybody. Right.
Well, so there's two ways though to avoid this surprise hurting folks. Number one is a lot of places now have ETFs, exchange traded funds, where you're not subject to, if Marco sells, Brett gets hit with a tax gain. If Brett sells, Marco gets hit with a tax gain. These are funds that are a lot more efficient from a tax standpoint. They usually don't have these large capital gain distributions. Or number two, and what's probably one thing that we focus on the most, asset location. Where do you own this fund? We own all of our tax inefficient funds in IRA accounts to the extent that somebody has both IRA and non-IRA money. So we have a list of all of our funds. We rank them by what's most tax efficient all the way to what's most tax efficient. And the ones that are most tax inefficient get put first in an IRA until all the IRA money is used up, and then it goes into a taxable account. And Vanguard themselves said that this would add up to 0.75% per year of a return, simply by not having those taxes paid year after year.
Yeah, precisely. This was our asset location strategy that a lot of thoughtful planners put into use. This is just when it gets highlighted like crazy. And usually that's us picking up kind of nickels along the way in a very just kind of thoughtful fashion. It's not brain surgery. It just requires a systemated, thoughtful, organized way to do it. And it's our job to do that. But I think this goes back to, we can't stop clients from having to pay taxes. You make money, you pay taxes. That's just how the system works right now. As soon as we can find a way around that, without drawing too much attention, at least, I'm sure our planning committee will come up with that. But until then, we'll do asset location and we'll trade around capital gains distributions, right? So we also do an analysis to see, okay, what's the distribution going to be? Is it worth trading out of that fund to buy another fund while that distribution gets paid? And obviously that's just a little tax arbitrage. Sometimes it makes sense, sometimes it doesn't. And then I think the biggest thing, which is where the industry is headed, is ETFs. I think mutual funds are the obvious gorilla in the room, but it's funny, the ETF growth trajectory is here, where the mutual fund's here, but asset size of mutual funds is here, ETFs are there. I still think it's too much lobbying money in Washington, where mutual funds are allowed in 401k platforms and ETFs are not. Like, that makes any sense? So it's going to be a long slog, but for us private wealth guys, the majority of our portfolios are made up of ETFs at this point, right? And I know a lot of us on the investment committee are pushing for even more of that structure. So more tax efficient. Yes, please.
Yeah, this is what the average person, I don't think, spends enough time looking at. And I think we spend an inordinate amount of time with looking at it. To me, I compare it to the guy that, washes the car and you can do a fine job washing yourself, versus the guy that's got the special shimmies and the special soaps. And, he just can do things a little better than you and I can do. And so rather than just having all your funds scattered throughout and not focusing on what's the after-tax return, I think asset location and ETFs are going to make a big difference in one's tax bills and not change performance whatsoever. Leave more money in your pocket.
I'm all in. This was a good one. It was funny to watch all the boggleheads on the Vanguard thing go crazy. Expectation settings, that's the name of the game.
All righty.
BH, thank you, my friend. We'll talk soon.
Have a good one.